Hi, good morning. Today is December 4, 2010, and I'm going to talk about the state of global markets. Well, let's begin with the S&P 500 and where it stands today. Now, the last 1 month, as you can see in the chart on the screen, has not been very great for global equities because of tremendous volatility. Now, there is a story. The world got very excited with the Fed's announcement of QE2, and so prior to the real quantum announcement of the QE2, the S&P 500 and most of the global assets, risk assets, rallied. And then came the QE2 announcement. There was China's inflation scare, and you see S&P 500 sharply corrected to the 50-day moving average. And just when it looked quite uncertain and there was a lot of bearish noises emerging, the S&P 500 sharply rallied, and yesterday, despite disappointing jobs data, S&P 500 closed in positive territory and is almost near the highs from where it corrected. And if you ask me what is the single reason that why this turnaround has come, you have to look at the chart of the dollar index. Now, the dollar index prior to the QE2 announcement sold off, and just when everyone was writing off the dollar index, post QE2 announcement, it sharply rallied. The pigs and the Portugal, Ireland noise in the Europe helped the dollar index, and the earlier trade, which was short dollar and long risk assets, started reversing, and so there was a massive short covering in the dollar index, and there was a sell-off in the global risk assets, and the dollar index rallied, took support at 50 DMA, and then again sharply rallied towards 200 DMA. And this rally that caused tremendous damage to the confidence in the global equities and the risk assets. But in last 3 days, the dollar encountered massive resistance at 200 DMA and it has sold off, which has helped not only the equities but also the commodities in big way. And that's why if you see the CRB index, which is the commodity index, it sold off, took support at 50 DMA, and then sharply rallied. And all this has helped tremendously to calm down the fears, and that's why if you look at the VIX index, you see there has been a sharp sell-off and it's almost trading at the year lows. The only trouble spot amidst all this has been the China. But there again, there is a good news that it is trying to hold on to 200 DMA after the initial damage that was done. So if I have to look at all the charts in totality and see where do we stand today, it looks like that the global equities are poised for sideways to upside kind of move because of the sell-off in dollar index. And as long as dollar index remains below the 200-day moving average, I think we are fine. The only thing that a trader needs to keep an eye on is what happens if dollar index strengthens above the 200 DMA. I think that's where the real sell-off and the damage may come to equities and all the risk assets, be it commodities and everything else. So as long as dollar index stays below 200 DMA, I think we are fine. I hope you found this video useful. This is Deepak Singh from State of the Market. Thank you. Bye, and you have a great day.